Last lesson, we discussed about net present value. Now this lesson today, we take the next discounted cash flow technique, and this is internal rate of return. Internal rate of return means the rate that equates the net present value to a zero. We say that when your net present value is a positive, you are supposed to accept the project. If it is negative, you reject the project. If the net present value is a zero, then that project can either be accepted or rejected. Now, we want to look at how to calculate that rate which can equate your net present value to a zero. That is a rate that you can apply in calculating the net present value, and it will neither give you a positive nor a negative net present value, but it will give you a positive net present value. We will be using interpolation method or the trial and error method to calculate the internal rate of return. Now, as you can see on the whiteboard, we've done an illustration there together with the solution. But before we come to that, I want us to take some notes. If you're writing, you can just write these notes. They are quite necessary as far as your lessons are concerned. So for those who are writing, before we come to that example, which is appearing on the whiteboard, let's first take an example, or we take some notes, some brief notes before we take our example. My name is Mr. William. I'm a publisher as well as an author in the field of finance and accounts. So in case you need assistance from our side, I will provide my numbers before we conclude our lesson. But my number will be 0727871093. The institution is Fatima Institute. We are based in Dhaka town. Now, remember what we are studying is investment appraisal techniques. Investment appraisal techniques are classified into two. One, the non-discounted cash flow techniques, which comprises of the payback period as well as the accounting rate of return. The other part comprises of discounted cash flow techniques, which comprises of the net present value, which we have covered, and it is already in our YouTube. So if you need lessons on the net present value, just go to our YouTube, Fatima Institute. The discussion is there with some examples. So the other type of discounted technique, apart from net present value, is the internal rate of return, which we are going to take right now. The others are profitability index, and discounted payback period. So for those who are taking notes before we discuss that illustration, which is on the whiteboard, we can take these short notes. Okay, so down there you can see in our notes, we said that internal rate of return is the break-even rate of return, i.e. the rate which yields a zero net present value. In other words, internal rate of return is that rate which, when applied, gives our net present value as a zero. We say net present value can either be positive or negative. So that's the definition of internal rate of return. Now, to calculate the internal rate of return, we've given some steps there. The step number one, we've said you'll be using interpolation method or the trial and error method. So step number one, determine the net present value using the given rate of return. So sometimes you can be given a rate of return like 10%. So just use the 10% which has been given to calculate the net present value if the rate has been given. Step number two, if the net present value in step one is positive, rediscount the cash flows using higher estimated rate of return to get a lower negative net present value. If the net present value in step one is negative, rediscount the cash flows using a lower estimated rate of return to get a higher or positive net present value. Then step number three, using the two net present values and the two rates of return, use approximation method below to get the internal rate of return. So what we are saying is that if you are given a rate of, say for example, 10%, if you use 10% to calculate net present value, there is a certain figure that you get, which can either be positive or negative. Step number two, you are saying if the net present value in step one, assuming you use 10% as your rate, and then it gives you positive number, you're saying you will discount the cash flow using higher estimated rate, meaning you can take 15%. So it has to be more than 10%. If you had used 10%. So if you use 10%, then it gives you a net present value which is positive. Then because you are using trial and error, you can use 15% or 20% or another rate which is above 10%. Then if it gives you negative, that is step number one, gives you a negative NPV, you rediscount the cash flows using a lower estimated rate of return to get a higher or positive net present value. Then you use the two net present values and the two rates of return to do what we call interpolation. IRR is a discounted cash flow technique which takes into account the magnitude and timing of the cash flows. It is also called marginal efficiency of capital or yield of an investment. Internal rate of return is equal to the discounting rate, which equates the present value of the cash flows to the cost of the project, and hence the net present value is equal to 0. IRR, so we'll be taking A1, that is the cash flows cash flow 1 divided by 1 plus r raised to 1 plus cash flow 2, because we'll be having a stream of cash flows, like maybe cash flows for 3 years may be given. For example, when I say A1 over 1 plus r raised to 1 plus A2 over 1 plus r raised to 2, that way, it's like what is appearing. Now let me show you an example of what I mean by saying A1 over 1 plus r raised to 1 plus A2 over 1 plus r raised to 2, that way. So before I come back to that, okay, I'll show you in a while. Let me complete first the notes, where A is the cash inflows for each period. So A there is the cash flows that you are receiving for year 1, year 2, year 3. Then the value of R can be found by use of either of the following methods: trial and error method, interpolation, or extrapolation. So in my case, I'll be using interpolation or trial and error. For trial and error method, the steps are there. They are similar to those 3 steps that I've given you there. Remember, the purpose is to create a situation where you have one rate which gives you a positive net present value and another rate which gives you a positive net present value. Then you apply them in our formula that we are going to study in a while. So our steps are there for trial and error. So you said you select any rate of interest at random. So take any rate, can be 15% or 7% or 95%. Take any percentage, and then you use that percentage to calculate your net present value. Step number 2, use that rate to compute the net present value of the cash inflows. Remember, this is a trial and error method or the interpolation method. So the first, you are saying you are taking any rate. Any rate can be any rate, whether it is 10 or 11 or 5. So select any rate of interest and then you use it to calculate the net present value of the cash inflows. Then if the rate chosen produces net present value lower than the cost, you choose a lower rate. That's important. Number C is quite important. That is, if the rate chosen produces net present value lower than the cost, you choose a lower rate. Number D, if the rate chosen produces net present value greater than the cost, you choose a higher rate. Number E, continue the process until the net present value is equal to 0, and that will be the IRR. Now let me go back to that illustration there. That IRR is equals to A1 over 1 plus R raised to 1 plus A2. That is like what is appearing on the board. If you look at that example which we have on the board, we are coming back to that illustration. You can see it there. We say that a project costs shillings 16,000 and is expected to generate the following cash flows at the end of the following 3 years. The year 1, 2, 3, the cash flows is 8,000, year 2 is 7,000, year 3 is 6,000. What is the IRR? You can see the solution, what you have done. Before we come back to our calculation, you can see us saying 8,000. So our 8,000 is A1 because it is the cash flows for year 1 divided by 1 plus R raised to 1. So our R is the rate that you'll have chosen. We are saying you pick any rate at random. So you can, if you pick 15, it will be 8,000 over 1 plus 15% raised to 1 plus 7,000 over 1 plus 15% raised to 2 plus 6,000 over 1 plus 15% raised to 3. Then you minus the initial capital outlay, 16,000. you get the net present value. So that is what we mean by saying by this illustration here. That is what we mean by that part. Okay, now away from that, I think we're okay. That my number is just at the bottom of that page. We are doing financial management. This is Fatima Institute Center for CIFA Studies. Our numbers are there: 0727 8710 93. These are our contacts. So I believe you are following. We are doing the internal rate of return, the rate that equates the net present value to a zero. That means once you have gotten your internal rate of return, say for example 16%, if you use that 16% to calculate the net present value, then your net present value will be a zero. Okay, let me move on the next page, which is an illustration, and I believe I'll come back to that in a while. Now, before I move to that side, there is this formula that I want you to have in mind. So when you are doing interpolation, you'll be using that formula here. You can see IRR is equals to L% plus NPV. Okay, because but we have said the internal rate of return means that rate which equates the net present value to a zero. So you'll be having two percentages. One percentage will give a negative NPV, and another percentage will give you a positive NPV. So L%, this L% here means that rate, the lower rate, which gives or simply the lower rate. For example, if you have taken 2% and 16%, then your L% is 2%, the lower rate. You'll be having two rates, lower rate plus net, the numerator here, this net present value at lower rate. If you use the lower rate to calculate the net present value, so that net present value which has been calculated using the lower rate will be our numerator. Our denominator, you divide by net present value at lower rate, the same as the numerator. That net present value which has been calculated using the lower rate, you plus the net present value which has been calculated using the higher rate. Then close the brackets, then you multiply the answer by higher rate minus the lower rates, the difference between the two rates. So that formula is very important as far as our interpolation is concerned. So understand that formula. So allow me to take up an example now. Let's go back to our example on the board. We are told that we have been told that a project costs shillings 16,000 and is expected to generate the following cash flows at the end of the following 3 years. So year one, this project will generate 8,000 shillings. Year two, 7,000 shillings. Year three, 6,000 shillings. Let's calculate the internal rate of return. What are we supposed to do? Okay, 8,000 is our A1. 8,000, the cash flow for year 1, over 1 plus R raised to 1 plus 7,000 over 1 plus R raised to 2 plus 6,000 over 1 plus R raised to 3 minus the initial capital outlay, which is 16,000, should give us a 0. However, we do not have the rate. We do not have the rate. In this case, we should calculate our rate through interpolation, trial and error. So you said you use trial and error method known as the interpolation. So pick any. In my case, I have picked 20%. I've picked 20%. So if I pick 20%, it means I'll be substituting my R here with 20%. So I'll take 1 plus 0.2 raised to 1, 1 plus 0.2 raised to 2, 1 plus 0.2 raised to 3. Because I'm saying I'll try 20%. With a trial and error, you just pick any percentage and then you establish what net present value will arise out of that. So try 20. So we try 20% there. So we substitute. You can see our formula there. What we don't have is this R. So you just use 20%. You can use 20, you can use 25, you can use 90, you can use 3%. So try any and establish what the answer will be. So if I pick 20, what is happening there? If I pick 20, let's see what will happen. If we pick 20, so if you do your calculation, if you do your calculation, you can take your calculation, 8,000 over, you take 8,000 over 1 plus 0.2 raised to 1 plus 7,000 over 1 plus 0.2 raised to 2 plus 6,000 over 1 plus 0.2 raised to 3. Now if you work out that, you get 6,666.7 plus 4860.8 plus that 472.2, and the present value will be 14,999.7. You can use 15%. I think you understand what I have done there. You understand what I've done there? The 6,000 there. It is coming out of this 8,000. You know, we have started from here. 1 plus R. We have taken 20% because we are using trial and error. We are using trial and error method. So 8,000 over 1 plus 0.2 raised to 1 plus 7,000 over 1 plus 0.2 raised to 2 plus 6,000 over 1 plus 0.2 raised to 3. The present values now will be there, those three numbers there. So present value is 14,999. Now I want to mention this present value of 14,000. You can see it is more than 16,000. Remember we said a project costs shillings 16,000. Now you are comparing this present value with the 16,000. There is a certain point that I have mentioned. I mentioned an important point when I was starting the discussion. There is an important point that I mentioned. Now here, if you remember what I said is that trial and error. Step 1, you said you select any rate of interest at random. Use that rate to compute the NPV of the cash inflows. If the rate chosen produces NPV lower than the cost, you choose a lower rate. And if the rate chosen produces NPV greater than the cost, you choose a higher cost. So what's the implication here? Because my present value, I get 14,999.7, which is a positive number. So because 20% is producing 14,999.7, which is less than 16,000. It's less than 16,000. So I'll take a lower rate. So I've decided to take 15%. Remember, my focus is to get two rates. Both have been taken randomly. However, one rate must produce negative NPV and the other rate must produce a positive NPV. So if I take 20%, it gives me NPV of negative 1,000. So I'm looking for, if I use 20%, my NPV is negative 1,000. I should take another rate which should give me a positive NPV. So I try 15%. Since 20% has given me, a negative, then I should take a percentage which is a lower percentage. So I have decided to take 15%. So 8,000 over 1 plus rate. Right now I'm using 15%. You are just taking randomly. You can even use 16 or you use whichever number that you want. So 1 plus 0.15 plus 7,000 over 1 plus 0.15 raised to 2 plus 6,000 over 1 plus 0.15 raised to 3. Okay, so present value, you work out that. If you take 8,000 over 1 plus 0.15 raised to 1, you get 6956.8. 7,000 over 1 plus 0.15 raised to 2, you are getting 5292.7. Then 6,000 over 1 plus 0.15 raised to 3, that's 945. So the present value is 16,194.5. So net present value, 16,194.5, you minus initial capital outlay of 16,000. And you get net present value of positive 194.5. So that is what I was looking for. I was looking for two rates whereby one rate will give me a positive NPV and another rate gives me a negative NPV. So 20% gives me negative 1,000 and then 15% gives me positive 194.5. So once you have gotten that, now remember that if, for example, you used 15% and your NPV was negative again, then you should have looked for another percentage. You cannot have two percentages whereby both are giving you negatives or positives. So you keep on trying until you just get any percentage whereby 1% gives you positive NPV and the other gives you a negative NPV. So 20%, if I use 20% as my rate, my net present value is negative 1,000. If I use 15%, my negative present, not negative, by my net present value is positive 194.5. Now once you have gotten that, the next thing now is to apply this formula. So remember this formula there now. You see that formula there. IRR is equals to L% plus the net. Remember now here you have you have gotten 20% and also 15%. So your L percent will be 15%. Then the net present value, which is produced by the low rate, and then we substitute. Okay. Now let's substitute. Now once we have gotten that, you can just make a follow-up from before we substitute. Now just make a follow-up of where we started. Make a follow-up of where we started. At our project cost shilling 16,000 and is expected to generate the following cash flows at the end of the following 3 years. Year 1, 2, 3. Cash flows we have 8,000, 7,000, and 6,000. What is the internal rate of return? Solution, we have shown that what we should do. Remember, internal rate of return is that rate which equates the net present value to a 0. So we are using interpolation or the trial and error. So I've picked 20%. You can use any percentage. You can even use 30 or 50 or 90 or 5 or 3. Try any, and then you establish what kind of a net present value you get. So my 20% gives me a present value of 14,000. It's almost 15,000. You can see the 15,000 is less than 16,000. So if 20,000 gives me 14,999.7, which is less than the 16,000, then my next percentage I'll take should be lower than 20%. So 20% gives me net present value of negative 1,000. Then I try the other I try 15%, which now gives me, if I try 15%, using trial and error, 15% gives me net present value of 194.5, which is positive. Now after that, now let's do the interpolation. Okay, now you look at that other portion now there. You can see what we are saying on that side there. 20% gives me negative 1,000. If I use 20% to calculate the net present value, if I use 20% as my rate, my net present value is negative 1,000. And then I use 15%, my net present value will be positive 194.5. So once I have that, then I should do the interpolation. I interpolate. IRR, you're saying, is L%, the lower rate. The L%, that one there, the L% is 15%. Because we have two rates, 20% and 15%. So 15% is lower or is smaller than 20%. You see, we are looking that IRR should be between 15% and 20%. Should not be less than 15% and should not be more than 20%. So my L, the lower rate is 15%. That is why down here we have used 15%. Plus 194.5. You can see our numerator there. We are saying NPV at lower rate. The NPV which is produced by the lower rate. The lower rate of 15% gives us what? Net present value of 194. 194 there. 194.5. So that is why the numerator there, you are substituting with 194.5 divided by net present value, which is given by the lower rate, and that is the lower rate gives us net present value of 194.5. So 194.5 plus, check our formula, plus net present value at higher rate. The higher rate of 20% gives us what? 1,000. So just ignore the negative sign. Then you multiply by, you remember our formula, you multiply by H minus L, the higher rate minus the lower rate. The higher rate was 20 minus the lower rate of 15. So if you work out that, you will get something like that. 15% plus, you work out that part, and then you get 15% plus that portion gives you 0.814. So IRR is 15.8%. IRR is 15.8%. So 15.8% means that if you use 15.8% to calculate the net present value of those cash flows there, then the net present value will be a 0. You can try that. You see whether what we are saying is correct. Our internal rate of return is 15.8%. 15.8%. You can use 16%. The answer will be almost the same. So that is the internal rate of return. So basically, that's how we go about internal rate of return. You can just pause your video and then maybe you can make a follow-up of what we have done there. Okay, to wind up, maybe I can, okay, can you take this as your assignment? Try your own percentages. The first one, I started with 20%. So don't use 20%. Use your own percentage, like that 2% or that 5% or 9%. You see what net present value you get. And then instead of using 15%, you try a different number. Use your own percentages to see whether your final answer is 15.8. Okay, that is what I've done on my side. Now let me show you other numbers which I have tried for the same or for a similar question. Now from the textbook, for those who have this textbook for financial management, maybe we can okay, let's try. I'll try that one. Make a so I did some correction there. I did some correction there. So I used what? I used 18%. So I did some using this. I used 18%. So 18% gave me 58.7, and I said that is less than 16,000 because the initial cost is 16,000. I'm doing the same question that we have done on the other side, but I'm trying different percentages. So instead of trying at using 20%, I used 18%. It gave me present value of 15,000, 458.7. Then, because 15 is less than 16, I take a lower rate, 14%. 14% gave 16,553. Is more than 16,000. So 14,000 gives me 14% gives me net present value of 453.6. 18% gives me net present value of negative 541.3. Then I substitute. I do the interpolation now. If I do the interpolation, my 14% comes there. I think I've explained this one. You understand what I'm doing here. And then my IRR, I get 15.82. 15.82% is the same as what we got on the other side. We used, even though we had used, we tried 20% and 15%. We got IRR as what? 15.8%. And that is why, even when I try different percentages, 18% and 14%, we have to arrive at the same answer. That is 15.82%. Okay, you can see, you can prove that. You can prove that as I have done here. And I got my net present value as a 0. You can prove that. You can prove the way I've done here. So this is because internal rate of return is that rate which equates the net present value to a 0. You can prove that. You can substitute the answers here. What you got, you can just come back here. If you are saying that your IRR is 15.8%, you can use 16% to be almost the same answer. So just take 8,000 over 1 plus 16% raised to 1 plus 7,000 over 1 plus 16% raised to 2 plus 6,000 over 1 plus 16% raised to 3, then minus what? 16,000. Minus 16,000. The initial cost was 16,000. You should get a 0. The internal rate of return will be a 0. Okay. Lastly, this is your assignment, but you still have some answers there. You can work out on that. Consider, your assignment is there. Consider a 5 years project whose cost is shillings 8 million. The project's cash flows are given as follows. Here, 1, 2, 3, 4, 5. The cash flows are there. 3.8, 2.4, 1,850,000, 2,950,000, 1,980,000. The required rate of return is 11%. Compute the IRR. So you can see what you have done there. We have been given 11%, so you can use 11% as a present value interest factor. And then your present values are there. If you use 11%, your net present value is 1,842,311. Now, this project cost 8 million. So 11% is giving us 8 million. It's giving us 9,842,311. So you try 24%. Since 11% is giving you a positive NPV of 1842,311, then if you try 24%, that gives you a negative 48787. Okay, so you interpolate. Do the interpolation now. You continue on the other side. You do the interpolation. You do the interpolation there. The interpolation is here. And then you continue. We have done all this. Okay. You can prove with your answer. Okay, I've given you the assignment, but you have also seen some solutions. The other illustration, an investment would cost shillings 20,000 and provide annual cash inflows of shillings 54,30 for 6 years. If the opportunity cost of capital is 10%, compute net present value. We did NPV yesterday. Then internal rate of return. Now this is a little bit tricky for you, but the solutions are there. Can you try to think about what I have done there? That is that example. Take that example as part of your assignment. However, the solution, you can see it there. But if you have a challenge, my numbers are just there. Just call for more elaborations. Okay, so we have done that part. We've done that part. Anything else remaining? I don't think so. I do not think so. Okay, the last one. You can take the last one. The last illustration, which you can still work on, is your assignment. A project cost shillings 16,200, and it's expected to generate the following cash inflows. Here's 1, 2, 3, 8,000, 7,000, 6,000. What is the IRR? We are doing interpolation. You took 10% as your first choice. Second choice, 14%. Third choice, you see, you must continue until you get 1% giving you positive present value and another one giving you negative present value. So IRR, you tried 14%, and 15% in the operation. Okay, try to follow what you have done there. The solutions are there. So in case you have a challenge, just call us. We'll help you. In case you need our help, we are available. We will help you. Okay, so that's I think that's enough for that lesson. So to conclude, we say that internal rate of return is that rate which equates the net present value to a zero. We use trial and error method to calculate the internal rate of return, or what we call interpolation method. And I think we have elaborated all the steps which are required in our case. So you can follow up what you have done on the whiteboard. I think everything is quite clear. Everything is quite clear. So that is enough for today. So next lesson, we'll take another type or another discounted cash flow technique, and I will take profitability index. So next lesson, I'll finalize the remaining in one lesson. That is profitability index and discounted payback period. I'll take those two. And then I'll conclude with the non-discounted cash flow techniques, which comprises of the payback period and the accounting rate of return. So that is the end of our lesson tonight. So have a good night. We meet tomorrow during the daytime lessons and also the late night lessons. My name is Mr. William. We meet again, God willing. Thank you. And remember to subscribe to our YouTube. You make a comment, you like the video, so that you may make us grow. Thank you, sir.